Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down what to do when the stock market takes a downturn. Do we buy the dip? Do we go all in with a big pile of cash to buy at a discount? Or do we stick with dollar cost averaging? I've been getting a ton of questions about this lately, so in this video, I want to cover the best investing strategy to handle this in the long term, but also what to do in the short term when we're in the middle of a market dip. The past few weeks, we've seen a lot of volatility and some huge drops, especially in the growth sector. This is mainly caused by fear and uncertainty with rising levels of inflation, growing interest rates in the near future, and of course, the spread of new variants. You've probably logged in and seen a lot of red losses across your portfolio, but right off the bat, I want to assure you guys, do not panic. For the majority of you out there, the only way to actually lose money right now is if you give in to fear and sell your stocks at a loss. That loss, you see, isn't real. Sure, your stocks are down, but you haven't actually lost any money yet. That loss only becomes real if you decide to sell your stocks, and that's the worst thing to do. If you believe in the long-term future of this company, then do not sell. Hold on to these stocks and let them recover. It might take months or even a year, but if this is a quality company, it will recover. And not only will you not lose a single dollar, but you'll actually earn a great profit in the long run. I've already made a whole video on what to do when the market crashes and how to avoid panicking and selling at a loss. So make sure you check out that video. But I want to start off with this important lesson to reassure you guys, especially new investors who've never experienced drops in the market like this. Market drops and downturns are totally normal and are to be expected. The stock market works in cycles, and there will always be another market crash or even a recession. No one knows when that crash will happen, but historically speaking, we see a significant market crash every 10 years or so. That's just part of investing, so you have to get used to it. In fact, market crashes can be a good thing. You've heard me say many times in my videos that when the market drops, I look at it as an opportunity to buy quality stocks at a discount. When investors panic and sell their stocks, that causes the stock price to drop, even though nothing has fundamentally changed with the company. It's still the same great company, still providing value to its customers and still earning a profit. But now the price is 10% lower than usual, so while many people are selling off their shares, I'm buying more shares and at a cheaper price. And when the market recovers in a matter of months and the stock price returns to normal, I'll have made a very easy profit. So yes, buying stocks at a discount can be a great opportunity, but that does not mean that you should try to time the market. If you've watched my previous videos, you know that I am a firm believer in investing in the long term. Time in the market will always beat timing the market. In fact, trying to time the market is impossible. It can't be done. There will always be another drop or another crash in the future, but no one knows when that will happen. The market could crash next month, or later this year, or 10 years from now. Nobody knows when it will happen, and anyone who claims that they know is lying. It is fundamentally impossible to predict when the market will drop. And even if the market has dropped, no one knows if it will continue to drop or if it's reached the bottom and will start to rise back up. By definition, you won't know if you're at the lowest point until it starts to climb back up, and by then, you've already missed it. If you're trying to time the market, meaning you're waiting to buy stocks at the lowest price, it is fundamentally impossible to know when the lowest point is. Even if you were at the lowest point, there's no way of knowing it until the price climbs back up, and then it's already too late. You've missed your chance, so don't even try. Timing the market cannot be done. To make it even worse, let's say that you could see the future and you knew exactly each time the market dropped. Timing the market still wouldn't work because there just aren't that many market drops. The stock market is always fluctuating up and down with an overall upward trend, but it's usually pretty steady. It doesn't really shoot up or shoot down too fast. So if you're trying to time the market, waiting for big dips, they don't happen very often. Looking at the US stock market over the past 20 years, we see two proper crashes where the market fell by over 20%, back in 2008 and of course in 2020. But if you're waiting for dips, you usually only see a handful of small dips every few years. In fact, there are periods of years without a single significant dip. A classic example is the bull market between 2003 and 2008. Here we saw a period of 5 years without a single drop of 5% in the US market. So if your strategy was to time the market and only buy the dip whenever you see a 5% drop, you would have been waiting on a pile of cash for 5 years before your opportunity came up. Imagine that, For 5 years, your cash has just been sitting there, collecting dust and losing between 2 and 3% in value every year due to inflation, while you're waiting to outsmart the market and buy the dip. Even worse, you missed out on 5 years of fantastic capital gains and dividend income that you could have earned if you had invested in the market throughout this time. So please don't try to time the market. It can't be done. And even if you had a crystal ball and you knew when the market was going to drop, it would still cost you holding onto cash, missing out on months or even years of growth. So instead of sitting on the sidelines trying to time the market for drops, it is far better to consistently invest in the stock market whether the market is going up or down. And this strategy is called dollar cost averaging. Historically speaking, dollar cost averaging is the most effective investing strategy, earning you the highest rate of return in the long run, plus it's actually the easiest and most stress-free way to invest. That's why I recommend it to everyone, especially to beginners. Here's how it works. With dollar cost averaging, you don't even try to time the market. You just consistently and regularly put money into stocks, no matter what the market is doing. If you work a job, put money into your portfolio every 2 weeks with your paycheck, or maybe once a month. Whatever schedule works for you, make a habit of putting money into the stock market on a regular basis and stick to it. We don't care what the stock price is at that moment. We don't care if the market is going up, going down, or going sideways. At the end of the month, we invest. This takes all the emotion and stress out of the equation. We're no longer worried about, am I buying at the right time? What if the market drops? Or should I wait until next week? Forget about trying to buy at the perfect time. The market fluctuates every single day, so sometimes we'll buy high, sometimes we'll buy low. But if we buy consistently, in the long run, it will smooth out, and we will be buying in at the average price of the market. And in the long run, our investment grows with the market. That's why it's called dollar cost averaging. If you've seen my members only videos, then you know that this is the strategy that I use. At least once a month, I invest money into my TFSA, RRSP, and margin account. The amount of money I invest can fluctuate depending on my expenses and income, but I make a habit of investing whatever I can every single month, whether the market is going up or going down. That's because I'm investing in the long run. All the money that I'm putting into the stock market is money that I will not need and I will not touch for at least 5 years, ideally even longer until retirement. So I don't care about the short-term market performance because I know that in the long run, my investments will grow in value. And dollar cost averaging can look different for different people. Some people do it entirely on autopilot, where a fixed amount of money will be taken out from their bank account once a month and invested into an ETF. There's no decisions or stress or work required. In my case, I don't have a full-time job, so my income can really fluctuate month to month, which is why I manually invest my money every month, and that's fine. Just find a routine that works for you. And if you'd like to see my exclusive videos to see my portfolio and what stocks I buy every single month, hit that join button down below to join my membership program. Unfortunately, the join button won't work on an iPhone, but it will work on a laptop, including MacBooks, and on Android devices. But it will cost $5 a month, so please only join if you want to, and thank you for supporting my channel. So that's the key to investing in the long run. You never want to be sitting with a big pile of cash waiting for the right moment. You should be consistently investing in the market and focusing on long-term growth. That way, your money is always being useful. It's invested and making money for you even in your sleep. But what about the short term? What if you have a big pile of cash and the market takes a dip? Let's say you get a big bonus from your job or you receive an inheritance. Now you have a large sum of money and the market is currently down. So what do? Do we spend all this money at once? Buy stocks in one lump sum to take advantage of this discount in the market? I'll say it again, do not try to time the market. If you go all in and invest all of that money today, you're effectively trying to time the market. The market is down, so yes, buying stocks today at a discount is cheaper than buying stocks a month ago. But what about tomorrow? What about next week? We don't know if the market has reached its lowest point, and again, it's impossible to predict that. But if you invest that large sum of money today, and next week the market falls even further, you've just missed out on an even better opportunity. Once again, I suggest taking the stress and emotion out of the equation. Don't go all in today, and don't sit on the sidelines waiting for the perfect moment. Instead, I would spread out my investment over the next several weeks. If you have $5,000 in cash right now, don't spend it all at once. My advice would be to invest $1,000 this week, $1,000 next week, and another $1,000 the week after that. Invest this money over the course of the next 5 weeks. Just like with dollar cost averaging, some weeks you'll buy high, some weeks you'll buy low, but overall you'll smoothen out the volatility of the market and you'll end up with a reliable average value. And once you've invested this large sum of money, continue on with your regular dollar cost average strategy, investing every month or whatever schedule you decide on. And remember, it's your money and your decisions. If you want to have some fun and try to outsmart the market, then go for it, as long as you understand the risks that come with it. Personally, I never try to time the market, but I do occasionally make decisions based on the current state of the market. Here's an example. If you've seen my Canadian dividend stock videos, you know that I am a huge fan of Canadian bank stocks, especially TD and BMO. They are some of my all-time favorite investments, and on any given day, I would be happy to buy shares for each of them because I believe in the long-term future of both companies. So this month, let's say I wanted to buy $1,000 worth of TD stock. Right now, TD is trading at all-time highs. It's still a great investment, and I'm happy to pay full price for it. But today, at this moment, BMO stock took a little dip. So instead, I decide to buy BMO stock to take advantage of this discount. That's totally fine. I'm not breaking my rules. I'm just choosing to buy BMO while it's on sale. But next month, I will likely buy TD to balance it out. This only becomes a problem if every month I decide to buy BMO over TD. In that case, yes, I'm basically timing the market and my portfolio will be unbalanced. My point is that you're allowed to have fun and make your own investing decisions. Just don't let yourself get carried away with emotions, especially fear and greed. And if you're not sure how to actually buy stocks or ETFs, click the pop-up at the top right to watch my Questrade tutorials, where I give a step-by-step walkthrough on how to buy Canadian and US stocks using Questrade, my favorite online broker. And if you'd like to get started with Questrade, click my referral link in the box below and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission-free. That saves you $50, plus I'll get a small referral bonus as well. So remember, if your stocks are down right now, but you still believe in the long-term future of the company, do not panic and do not sell. Let them recover, and you can use this opportunity to buy quality stocks at a discount. Just don't spend all your money at once. Spread out your investment over the next several weeks. The stock market can be very unpredictable in the short term, so do not try to time the market. Instead, take advantage of dollar cost averaging and invest in the market regularly, every month or every 2 weeks. This strategy not only outperforms waiting for the dip, but it's also simple and stress-free. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel on YouTube, and hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the link in the box below or click the links on my homepage. And watch out for scam accounts. My real account is Canadian T-shirt, no punctuation or underscores. So thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.